Ten common myths in the mortgage world. Welcome to Money Talks podcast number 4.
Robert, thanks for having this interesting thing to talk about. So let's talk about the myth number 1. You need 20% to buy a home.
Yeah, so a lot of people don't know that that's a myth. People think that you need to have 20% down to get your first home, but honestly, it's just not true. There's loan programs out there like conventional for first-time home buyers, FHA, and some other loans as well, where you can buy with far less than 20% down. FHA, it's 3.5% down, and conventional, it's 3% down. But if you get multi-unit homes, sometimes it can go up to 5%. But it's a common myth. You don't need 20% down to get into your first home. And that brings us to number 2.
Well, you want me to? I mean, I just want to add to the viewers why the 20%. It used to be the thing in the 50s or 70s, but the whole thing changed with the introduction of private mortgage insurance. The banks were not lending more than 80%, but then private mortgage insurance says, you know what? Go ahead. We will cover your losses in the event. In the event client goes in default and you have a losses up to 80% in your balance. If you ended up losing some money on that client, the private mortgage insurance will cover it. And that's why private mortgage insurance was introduced to help banks to advance more. And that's how all of these current programs, which is conventional FHA, came to place in the most commonly in 80s and 90s. And then it became, Main Street to borrow with less than 20% down. In fact, today, I was actually looking at these myth situation and I counted my loan applications. About 70% of the loan applications that I took in the past 12 months, 70% were closed with less than 6% down.
Yeah.
So it's even though it's a common myth, majority of the loans we're closing today, and I'm talking about from real life experience, are way less than 20% down.
Yeah, you're actually kind of in the rare. Yeah, you're more rare to have 20% down on your first home, especially than not in this day and age.
Yeah, just saving the monies, and then of course you can avoid PMI. You can get maybe a better rate with 20% down, but the reality is just doesn't support that to make it very common.
Absolutely. Well, myth number 2 is you need a perfect credit score to buy a home.
Well, that's a good one. You don't need a perfect credit score. By perfect, I would refer to 720 plus. But mortgage programs today, we've seen FHA loans. There is called manual underwriting, which is we can do FHA loans in the mortgage world, especially mortgage brokers. It's not really available through the mortgage bankers. 500 to 579, we can do a FHA loan with manual underwriting. Then FHA loans 580 plus, it's automated underwriting, meaning that we can give you pretty much a good determination whether the loan is going to work with that score. Conventional loan, minimum loan amount is 620. And then obviously there are very interesting creative programs out there, meaning that in the event you're able to compensate lower credit score with a substantial down payment, then the credit score can be significantly low. And there are mostly non-QM programs. In one particular case, we have an investor that says, you know what, if I'll do no credit check loan at 50% loan to value. So, obviously it's going to require substantial down payment, but and the rates will be higher than conventional or traditional FHA loans. However, if that's the case, then if you have a below par credit, expect to pay more down payment and expect to show a better income and a better credit, and better, DTI to compensate for all of that.
Yeah, and you still sometimes will get a higher rate, but in most cases, it's still financially smarter to buy than rent.
No, of course, and then you just happen to be my next myth.
Okay.
Yeah, renting is always cheaper than buying.
Yes, so if you're a person just getting started out, you don't know you're in college or you're just outside of college and you're working at this job, but you're thinking about moving. You know, like if you're not in a steady place, yeah, renting might be for you. But if you're like, this is my job, I know it's going to be my job for the next 30 years. I love this job for the next 5 years or whatever. Or I love this town. This is where I'm going to live. It makes sense. My wife loves it. I love it. We both have jobs here. Whatever it may be. Buying by far makes better sense than it is to rent. Because when you're renting, you're just giving someone else money every single month. You're giving someone else money, giving someone else money. And when you buy, even though right off the bat, you're paying a lot of the interest up front. You know, the interest is higher than your principal, but you're still paying some principal. And then on top of that, you're seeing appreciation in home values. On average, homes go up around 4.5 to 5% a year. So yeah, you're taking out a loan, but if your house is $300,000 after the first year, it's going to be $315,000, while also you're paying yourself a little bit more and more and more, and then it's an asset you eventually own. So buying, even if it's a higher interest rate, because you can refinance down, always just about makes sense versus renting.
And to add to that, I would like to show the back-end story. The back-end story comes, guys, when we receive a reverse mortgage applications, which is interesting. In many reverse mortgage applications, the individuals are in their 60s, 70s. The reason they apply for reverse mortgage because they haven't had good retirement planning, unfortunately, and now they have this health care, other expenses, and the only asset in reverse mortgage situations we've seen is the home.
Yeah.
Free and clear home that those people paid for 30 years. They had a free home since they turned 50 or so on and so forth. And now they can look into that as leverage at this final years. And then believe me, if the same individual probably who hasn't had retirement planning, but he could have been paying rent all this time, may end up in the same situation, but he will not have that asset to use in case of that. In case of that situation, so meaning that it's proven to me that the reverse mortgage programs are created specifically to provide that last resort, because there is no income verification, no credit requirements at that time. So that's number one. And number two is that it's a mental goal, because we all need to have a short-term and long-term goals. If you paying rent and rent and rent, your long-term and short-term goals are always the same. Just pay the rent.
Yeah.
Exactly. Like, okay, I have my rent due next month, but probably next year I'm going to be also renting, and who cares about it now, but I'm still going to pay rent. Versus with a mortgage, you can buy the house, you can look at that principal balance. It's going to be, it may look higher in the beginning, but you make a goal in your head saying, you know what, I want to attack that balance. I want to be smart about this debt. And then eventually, don't look at 30 years. Nobody says that 30 years you have to pay 30 years.
Yeah.
If you make a strategic decision to pay off that loan in 5, 7, 10 years, guess what? In 7 years, you're going to have a free and clear asset, no more rent, no more mortgage, and then you have a security, meaning now you can really enjoy life without worrying, oh, how am I going to make that payment next month?
Yeah. Well, and another thing that people don't think about is that when you buy a house, say you buy a house, you have a $2,000 monthly payment.
Okay.
And yeah, your rent might have been $1,800, but you got into a little bit bigger of a house, you got a nicer house than what you were renting, $2,000 a month, every month. For one, that's an appreciating asset. And in 10 years, those houses that you were renting for $1,800 isn't going to be $1,800 anymore. It's going to be exponentially more in rent. Yeah. So you're forever buying. When you buy a house, your payments, in 20 years, you're paying in yesterday's money. You're not paying current money because inflation hits every single year. And other people here will buy a house, your asset. I can make more cash I can make more money on my cash than 5% a year. And yes, in the S&P 500 and a lot of other places you can put your money, you can make more than 5%. But the thing is, do you have $300,000 right now?
Yeah.
And you have to have a place to live. So it's just a lot of different stuff. But
No,
Yeah.
absolutely correct. So it's just for a majority of people, stocks, all other investments. Investment always implies risk.
yeah.
Rent, just like taxes,
Yeah.
that you just can't get away with.
Yeah.
You have to live somewhere. Your options are kind of limited. You can go, the home, maybe apartment, then maybe a mobile home, and then I'm sorry, but then there is maybe a
Van.
van. Yeah, so meaning that
Yeah.
we certainly want, as we grow in life, we want to improve our lifestyle. So the home is kind of that goal. It's part of American dream, and then
Yeah.
I think it's just that rat race that
Yeah.
everybody is in every day. Home ownership is one way closer to financial independency and getting out of that rat race.
Absolutely.
So
Myth number 4 is you should always go for the lowest possible interest rate.
oh boy, that's a good one because every day I get the calls. What is the rate? What is the rate? And I always correct my borrowers saying, interest rate is not what matters. What matters is APR. What is APR? Okay, so look, just very simple example. You buying a house for $300,000, okay? $240,000, let's say, is the loan amount that you're borrowing. Then, so think about it, right? We're following. So you got a 5% interest rate on that $240,000. Great, good. You're doing good so far. Then the lender, the mortgage broker, the third parties hit you up with the borrowing costs, which is finance charges, origination fees, underwriting fees, tax cert fees, flood fees, insurance fees, private mortgage insurance costs, all these fees. Let's say you borrow $240,000, but you're paying $20,000 in fees at closing. Imagine, just an example, it's a little bit high, but imagine. So now, meaning that in addition to that 5% interest rate on $240,000, there is a $20,000 that will be amortized through the 30-year of the loan. So it's another $600-700 a month.
Yeah.
And if you add it to the percentage of the loan, your interest rate is no longer 5%. It's probably 5.33, 5.34% APR, just because we amortize the $20,000 through 30 years. So when somebody tells you, oh, it's going to be 5% rate, always ask, okay, what is my APR? And if the person cannot give you a good answer, like, well, don't worry about it. That means that, okay, so that means you're going to expect some high fees you're going to pay up front.
You do not want to hear "don't worry about it" from the people dealing with your mortgage loans.
Yeah, exactly. Yeah. Forget about it. Like, you say
5% rate.
Yeah. That's what I'm saying. So ask about the APR, and then always compare. Always compare. So meaning that, I would always say to people, saying, look, banks are on every corner.
Yeah.
They are. I mean, we're all in the same business. We compete, and you go to your bank, sit down with a banker. They're going to do your credit. They're going to do all the checks, and they're going to give you a loan estimate. Say, hey, we're looking at this rate, and we're looking at this APR. Don't immediately jump on it and say, oh, great, I got approved, so let me just take it. I've seen personally, because we're in a wholesale side, we as a mortgage brokers, we work with the wholesale lenders. These are the lenders that do not offer services to public. And their rates are significantly discounted compared to the banks. So I've seen the loan estimates where we were able to, just most recently was a loan estimate from a major bank. And then we came, and then APR was like a 7 and a change. In our case, we dropped APR to 6 and a change. So it was from a major bank.
Yeah.
I'm just saying, don't compare the rate. Compare the APR. What is the APR? How much would it cost to borrow? And just to conclude, what is the financing cost? Financing cost is a very simple formula. Imagine you're buying $300,000 home cash. So it's going to be $5,000 in closing costs as if you're buying as a cash. But then if you're buying with 300,000 purchase price and 250,000 mortgage, then you have that 20,000 financing cost. So meaning the closing cost total is 25,000 versus 5. Meaning that because you're borrowing, you have 20,000 additional closing costs. That's your financing charge. Meaning that if you did not have to borrow, you would not have to pay those charges. All of those charges become part of APR.
Yeah.
So that's how it is. Don't compare the rate, compare the APR.
Yeah. And to quickly conclude this question, also your loan. There's different loan types. FHA, you're going to have a little bit of a lower rate, but PMI is going to be higher. And then conventional, you're going, also FHA, you're going to have PMI on your loan for the life of the loan. So to drop that, you're going to be forced to refinance at 80% LTV.
Yeah.
But with conventional, it will automatically drop that once you've hit 80% LTV. So once you've paid off that 20%, or when you have 20% loan to value, it drops it. And FHA, you have to refinance. So if the rates are like crazy good, it might be smarter to try to get a conventional loan. But conventional does have some higher requirements than FHA. You have to have a little bit better credit score. You have to have your ducks in a row just a little bit more.
Lower DTI, etc.
Yeah, and lower DTI.
So what is it? Whose turn is that?
I think you're 5.
5. Okay, so you should buy a house for what you are pre-approved for.
Yes. So buying a house for what you're pre-approved for, you absolutely can. And I'm not saying you shouldn't. I'm not saying you always shouldn't. But the myth is you have to buy a house that you're pre-approved for. If you get pre-approved for $300,000 or $400,000 or whatever you got pre-approved for, you can choose a house that's a little bit less than that. You should look at your own finances and think, oh, well, if I go with what I'm pre-approved for, my monthly payments are a little bit higher than I'd want them to. And I want to be able to save. I want to be able to put some cash away over here and cash away over there. Or I want to be able to pay this home sooner than later. So I'm gonna get a $300,000 or $350,000 house, but make additional payments and pay it off even early. So I think getting the house you're always pre-approved for isn't the worst decision. It's not a bad decision. However, going down a little bit, looking at your own personal finances and making a decision for you or you and your family is always smart.
Yeah, and to add to that, from the practical standpoint, because I read these pre-approvals pretty much daily, in almost 100% of the time, my clients ask me to put the maximum amount they can borrow on pre-approval. It's a psychological thing. Why? Because when let's say you've been pre-approved for $600,000 loan, but you're not really on the market for $600,000. In your head, you're like, you know what? You looked at the houses; they're about $450,000. So they want to bring it, and when you put the pre-approval with a stronger loan amount, it looks pretty good to the seller, to the selling agent. They're like, okay, you know what? Looks like this guy can really, afford a bigger loan. So the chances of him closing are much higher than the guy who's approved just at that amount.
Yeah.
Number one. And number two, just one thing to mention, pre-approval, guys, whether it's your local banker or the mortgage broker, we are assessing your income, your credit, and your employment situation based on initial documents, the minimum amount of documents that we require. However, when the loan goes into the process, it's going to be looked at by the underwriter. And that's a decision maker. At the end of the day, he or she will look at it and say, well, this employment is not really stable. Well, this income is not really consistent, so I'm going to take away a portion of it. And at the end of the day, that pre-approval, so-called, which we reasonably provided, may be adjusted, meaning that's why maybe the maximum loan amount may unlikely going to go up. It's going to go down. If it does, it's best to have pre-approval at max, but count for a little bit less, so there is a wiggle room. For in case underwriter disagrees with the initial assessment done by your banker or your mortgage professional.
Yeah. And myth number 6. 30-year fixed rate mortgage is always the best option.
Wow.
You're like...
Yeah. No, I mean, 30-year, there is the CFPB says that, okay, we're going to call a 30-year mortgage loan as a conforming loan, meaning that it's what government is willing is considered to be a standard traditional loan. But it's never been, today, with the Feds dropping the rates a little bit, I'm seeing 15-year refinance or purchase rates so aggressively priced that if I'm looking at the borrower's DTI affording him or her 15-year loan in the mid-4s,
Yeah.
interest rate in the 4s, which is you guys haven't seen, but it is happening today, versus 30-year loan in interest in the 6s, I say, look, hold on a second, let's crunch some numbers. The difference turns out to be a few $100 between one to another, especially in smaller loan amounts.
Yeah.
And if the DTI is there, I tell the client, look, 15-year loan, you pay 1/3 of the lifetime interest that you paid on the 30-year loan.
Yeah.
You repay your loan in 15 years, and if it looks reasonable and affordable to take that, it's certainly an economically feasible option.
Yeah.
And contrary to that, in non-QM world today, we have 40-year loans with not just 40-year loans. We have 40-year loans with the first 10 years of payments of interest only. So it's that,
Yeah.
it just what I'm saying is that 30 years is your, I wouldn't call it a gold standard. I would call it as the most popular product. But if we need to stretch the DTI a little bit to make it a little bit, in fact, FHA is working on introducing and making 40-year as a conforming loan, so they want to create affordability.
Yeah.
So 40-year loans we have, and we can go to 15-year loans. And then don't forget, there's always the recasting options. Let's say you've had a loan for a little while, and then let's say you say, you know what, I had a loan for 30-year loan, I paid 7 years already, so I'm 23 years remaining, but my economic situation have changed, so meaning that I would like to refinance today, and then if economic situation changed for better, I want to either make a 23-year amortization for a new loan, you can request that, or you can say, you know what, 23-year payment at my current interest was $1,500, how about I just trim it down to 17 years, Frank?
Yeah.
And then my payment is going to go to $300 higher, $400 higher. Can I do it? I probably can. Ask a mortgage professional, can you make this custom loan term for me, please? And then listen, there's nothing we can do.
Yeah, absolutely. Well, and in the final thing is there's adjustable mortgage rates. ARM loans. ARM loans traditionally have lower rates, but the rates after 5 years, 6 years, 7 years, they can fluctuate up or down.
Yeah.
But some people, when they move and they buy a house, they know that I'm going to be here for 4 years.
Yeah.
I'm going to be here for 4 years. Like factually, that's what I'm doing. So they might go there and they might just get an ARM because that's the lowest interest rate. And it won't change in 4 years, but after the 5th year it would. So if you factually know, you might be able to get a lower rate. And if you're not planning on staying there forever, but you don't want to just throw money renting.
Yep. So who's
myth
starting?
number 7.
Oh, okay. You should always wait for the perfect time to buy a home.
Yeah.
Okay.
So that is something.
Are we talking about that guy who's still waiting for the market to crash?
Yes. So
that's the guy.
That is something that I hear from friends, from family, from
your uncle,
from your uncle. I hear it from everyone. That's like, hey, I'm just the houses are too high. The rates too, I'm going to wait.
Mm-hmm.
But I mean, we even have a short video breaking down if it's better to rent or wait to save up and buy. And the numbers will blow you away. It is always better to, remind me the question again.
How to time the market.
So you're not going to time the market. Annually, houses go up 5%. That is over the last 50 years.
Oh yeah, I mean since the 70s.
So since the 70s. It's gone up 5%. It's gone up. What did we see during COVID? We saw house prices go up. The house price from 2019 to 2021 when everything crashed for like a week and then everything just went back up. insane. Yes, rates were fantastic then,
Yeah.
but now rates got higher, and we're seeing them drop and level out some. But it just doesn't make sense to time it. It never makes sense to try to time it perfectly because you don't know.
Few reasons why you can't time the market. So let's say that the reason there are financial analysts wearing ties and suits is because we just can't hire fortune tellers.
Yeah.
We just can't, because we need somebody to look professional. But guess what? Between that 17th to today, the biggest crash that happened was 2008 crash, right? The property values did go down for significant. Took about 5 to 6 years to recover from the crash. However, let's don't forget about something. So it's hard to say that millions of American households were expecting the crash. So it's not that they timed it. You know what? Let me buy a home 2 months before the crash. So millions of people could have not planned that event. Otherwise, it would have not been millions of people who ended up in the crash. Secondly, the COVID. So you're saying that millions of people were expecting the total shutdown? Nobody expected. Or who did expect that in 2021, 2022, all those years, U.S. government will be printing money in trillions, fueling the inflation and causing this rise in the home values? Who? I mean, let's say if anyone said, oh, you know what, let me time it. I know it's coming. Well, then that person would have been a billionaire, but we don't have that crystal ball. So one thing is just long-term and short-term goals. Your short-term goals is to pay your bills, to pay your rent, to pay your expenses, and save. Long-term goal, how to achieve financial independency. If you make that goal in your head, it's your goal. Forget about market. It's not your uncle's goal. It's not your friend's goal. It's your goal. And if you're going to be making your personal financial decisions based on how everybody else is making you believe in it, then you will never pull the trigger. If you made that goal, make the goal based on today's facts, today's feelings, how you feel. And if you agree with your uncle, go. That's fine. You have an opinion. He has an opinion too. But as I said, if your goals are in line with your acts, then market is huge. Meaning that it's millions of transactions in mortgage world happening every year. So what are we doing? Like, we're going to wait? I mean, I don't know. It's just what I'm saying. So make your personal goals and personal decisions based on how you understand and how you feel. And regarding the crash, one last thing about the crash. In 2022, in early 2023, the rates are going high. The construction developers and construction loan costs went from 7-8% to current. Some of my new construction clients, they're paying 12 to 14% in construction loans. They dropped their construction business to 30% that it used to be in 2020, 2021. So that's causing a huge shortage of new inventory being delivered in the past 2 years. That's your presidential candidates are promising, oh, we're going to build you 700,000 new homes. Let's be realistic. If you're a developer and if you have to borrow 14% rate, you're not building too much. You're keeping it safe. So that shortage that was created in the housing inventory throughout the U.S. is going to take now another 3-4 years to just catch up after the rates improve. And I don't know, God knows when they're going to be back to 7-8% on the construction loan side for the inventory to be replenished. Meaning that if there is less inventory of homes and there are more buyers, what indications of crash can that provide? Very little. So that's what it is.
Absolutely. Number 8, you can't get a mortgage if you're self-employed.
Oh, yeah, that's nothing but untrue, okay?
A myth.
A myth. It's a myth as it gets. So not only you can get even conventional or FHA loans as a self-employed, you can. The only thing is you're going to have to be strategic about your tax filings. You're going to have to be a little bit more flexible as to, not taking all the crazy deductions and maybe, because on paper you still need to meet the DTI. If you take all of the deductions the business could take and the pass-through income is
relatively low, you're not going to meet the DTI. But in that cases, for that reason, market created non-QM programs that don't even care about your taxes. They don't care about your W-2s. They don't care about your pay stubs. If you're a self-employed individual, business owner, and so on, bank statements, 12-month bank statements, let's take a look. What have been your real cash flow, meaning that, before taxes and expenses and depreciation and all of the write-offs you want to take, and then see what your owner benefits from that business is. And they make that assessment. You can agree or disagree with underwriter assessing your income based on bank statements. And if you disagree, call your CPA, call your tax preparer, say, hey, I know I make more. Can you reassess what underwriter just did and see if my expense ratio is actually less than 50% and help me write a letter saying that you, Mr. CPA, looked at my financials and it looks like the expense ratio is 20, 30%. Especially if you're in the professional industry, let's say home-based, you run your business from your home, your accountant, real estate agent, your marketing professional, your consultant, all your expenses are your cell phone, maybe car bill, and little home office. And everything else is just, not the business expense at that point, even though you may be writing it off in the taxes. But from that point, CPA is going to say, look, realistically speaking, it looks like, all those three categories of expenses, your card, mileage, cell phone, and home office, is really 20% of your gross business income. So here's the letter. We're going to bring that letter to the underwriter saying, hey, Mr. Underwriter, you took 50% expense ratio. It turns out to be only 20%. This guy makes a lot of money. Underwriter would say, well, yeah, if a professional said it, so I agree. Yeah. So all of a sudden you have a tremendous income, and we're going to calculate DTI based on that income, and then we're going to still get whether you're self-employed, whether you are, business owner, whether you may have a seasonal employment, or maybe you have an irregular income. All of those things can really fit into this non-QM loan. So don't be discouraged. If you went to your local bank and they said, oh, it's not possible. I just spoke to one of my borrowers this morning. He went to his bank, and the banker laughed at him, saying that it's not possible. And guess what? I'm giving this client that DSCR loan already, his investment property. His bank said, oh, we need to look at your global DTI. I said, what global DTI? It's another investment property. I don't care about your DTI whatsoever. As long as the property cash flows and covers, your proposed mortgage payment, then you're good. The guy couldn't believe what he heard. I said, yeah, that's what it is. That's why I'm telling you, shop. It's a banker is not, don't shop the rate necessarily. Also shop the mortgage property. Make sure it's actually available to you before talking about the rate, because, it's it's a criteria that needs to be accounted for in a global scale of things. Yep. So what's the next myth? It's on me. Yep. Oh, okay. Only upfront costs. No name. Okay. So the down payment is your only upfront cost when you buy a house.
Yes. So, guys, when you buy a home, you hear 3%, 3.5%, 5%, 20%. That's what you're putting on the house. That is all just what you're putting on the house. You can expect normally to spend another 3 to 5% on closing costs.
Yeah.
So when you put 3% down, you need a little bit more on closing costs. And then on top of that, it's suggested to have another 3 to 5% on once you get in the house, because something might need to be repaired soon. You maybe paint the walls, carpet. So probably another 7%, 7 to 9% on top of your down payment when you go to buy a house. And don't let this discourage you. It's just the realities of buying a house, though.
Yeah, no, for sure. From practical standpoint, before closing, expect to spend $400 to $700, depending where you are and depending on the property type, on appraisal.
Yeah.
Many states, before you get a property insured, require you to conduct 4-point inspection with mitigation of the roof. That inspection alone can cost, depending on the size of the house, between $300 to $600. So these are the costs before you even sit down to the closing table. At the closing table, expect to pay title insurance, governmental fee, lender fees, mortgage broker fees, and the biggest one in some cases, in some states, is a prorated escrows, meaning that if your tax agreement shows you, first of all, the landlord will then require you to prepay for the entire premium of your property insurance for the year in advance, and depending on what stage of the year you're in, the lender will require you to escrow the portion of the taxes. So you, with your following monthly payments, you can build up an escrow balance for lender to pay your taxes when they're due, usually in November, December of each year. Some places that even have it twice a year because of the size, because of the amount of the tax, especially New England states. So all of that is going to add up. So when you come into the closing table, okay, so I have a down payment, 35%, whatever you were, whatever loan product you were doing, expect those closing costs. Depending on the state, as I said, I've seen in states like Oklahoma, they're going to be low because the closing costs are nominal, fees are low. Great, red states. But then you go to some of the blue states, sorry, but that's just the reality. Illinois, New Jersey, Connecticut, I see the closing costs, between insurance and tax escrows at $10,000, $15,000 to put an escrow so they can get paid when time comes. So on top of closing costs, so you count 3% on the lower end. I've seen 7% and the higher end or something, in addition to the loan amount or purchase price on top of it. And as Robert mentioned, our post-closing expenses, you're gonna have to have some reserves. You can't come out of closing almost dry, because how are you gonna pay the next month mortgage payment? It's just risky. It's risky business. So make that adjustments to how much you need. And also, don't forget, always in negotiating at the price, ask for seller incentive. Most loan programs allow up to 6% of the purchase price in form of seller incentive. Don't negotiate the price, negotiate seller incentive. Those incentives will help you cover your closing costs. So that's rule 101. I tell all the clients to do that. And then in addition to seller incentive, you may, if you really want to squeeze the deal in your favor, you can ask participating realtors to maybe provide some credit, and especially the realtor representing you. And with these new laws, you may probably, and if the seller is willing to compensate your realtor, and your realtor agrees to maybe out of that compensation provide you some interested party credit, it's worth asking, because it's money on the table that may help you to close the loan.
Well, and the worst thing to say is no. I feel like you should always ask. I love negotiating, and because sometimes you get told yes, and you're like, oh, awesome, that just saved me a lot of money.
No, it's crazy. It's crazy.
Yeah.
It's crazy.
So last and final myth, number 10, pay off your mortgage early always makes the most financial sense.
This one is it has both sides. So
Save the hard earned for last.
it's not really a myth, to be honest with you, because for a majority of people, especially the people who are conservative and like taking it safe, I've seen it a lot. I have so many clients that own houses free and clear, and when they need to access equity, it's basically like pulling teeth out of them. It's like, man, you need the cash for your business, you need the cash for this expense. Let's go. Oh, nah, I just don't want to do this. So they're very debt conservative people, and I appreciate it. There's nothing wrong with that. It's in fact probably the right thing to do.
Yeah.
And those are the guys who viciously attacked that mortgage when they first got it in the 90s and 2000s. They had no more mortgage on the property. So did they make a good decision? At this time, they did. They're sitting on a free and clear home. So I was like, I guess they are. On another hand, if you're a business owner or real estate investor, and or generally an investor in maybe you have some businesses, or let's say you partner up with with your friends and you guys together invest in something, it's pretty simple. You have to look at your track record, right? Let's say 20% of your portfolio was in the stocks last year. You look at the beginning of the beginning of the last year balance, cash value of your stocks, and the end of the year. Calculate what your return had been. If you invested for more than 1 year, average that for the past 5 years. And let's say that has averaged you 9% average return and your mortgage is 5% rate, then maybe instead of taking the money and reducing the principal, that money probably is going to do better if you invested in stock. A stock investment that you've been doing because you have a track record of your first-time on this. And then, that 9% will cover the 5 and still leave you with 4. Because remember, the interest under the mortgage is tax deductible. So that 5% interest offsets a portion of 9% income on a dividend or stock appreciation, whatever the case might be. And that's number one. So if you have the product that makes you more money on the return than the interest rate on the mortgage, it's worth doing it. But once again, it's your habits as well. Because repaying the mortgage is conservative, meaning that the home is there, you paid it off, it's not going anywhere, your family has a place to stay, you have, roofs over your head. So there's always, pros and cons. And I would say that, let's say your mortgage is 5%, but your investment opportunity is 7%. That 2% spread is probably not worth the risk. Yeah. But if, let's say, there is an exponential opportunity, which provides a reasonable risk, that can provide you maybe 10, 12, 15% return every year while you're paying 5% on the mortgage. Maybe it's worth taking that extra money that you're going to send to reduce the principal instead to invest, because that's going to create more wealth. That's going to allow you to pay your mortgage faster as it goes.
Yeah, absolutely. So, well, that's 10 myths in the mortgage world. Thank you guys for being here for Money Talks episode number 4. Frank.
Thank you guys. See you soon.